In this video lecture, I will be covering the topic of risk and return. This is the reference book for the chapter number 8 of Fundamentals of Financial Management by Brigham Houston. These are the objectives that will be covered. What is the concept of risk, the concept of expected rate of return, what is standalone risk and return, how do you use historical data to measure risk and return, correlation, portfolio return and risk. Now, if you look at this picture, you can see that this person is saying to the other person that, okay, I'm going to say you're quite risk averse. So, what does this risk averse word mean? It simply means that investors dislike risk and they will try to minimize the risk from the investment. Risk is something that is always present in every decision that a person takes. So, if you decide to purchase some property or real estate, then you're taking the risk that maybe the value of that property will not go up. Similar is the case with financial assets. So if you're purchasing let's say a stock, then the risk over here is that the stock price might go down, or you might not get any dividend, or the stock market might crash. So basically investors are risk averse. They are scared that these things might happen. And on the other hand, investors like return. So if the stock is giving a good return, which means it's giving good dividend payments, and if the stock price is going up in the stock market, they will be happy. So basically investors are risk averse. It simply means that they will want to minimize the chances of loss. Now, moving ahead, if we look at the definition of risk, so risk is defined in Webster as a hazard, a peril, exposure to loss or injury. Thus, risk refers to the chance that some unfavorable event will occur. So, anything that is unfavorable is considered to be risk, like I already explained. So, if you're purchasing a stock, the unfavorable event will be because you wanted a high return. It might be that the stock market actually crashes and your stock goes into loss. So your investment goes into loss. That is an unfavorable event, and that is a risk that you will have to bear. An asset's risk can be analyzed in two ways. Number one is a standalone basis, and number two is on a portfolio basis. Both are different cases. Standalone basis means that you have just one stock. So you have made investment in, let's say, just one stock or one bond. So you're looking at each financial asset separately. Whereas portfolio is a combination of financial securities. So it's a combination of financial securities. Actually, in reality, your portfolio does not necessarily only have financial security. So if you consider a person's wealth, and if you want to look at the whole portfolio of investment, so some people might have purchased some stocks, then some money will be in bonds, some money might be in banks, in saving accounts, and some money might be invested in property, and the property might also be at different places. So these are all different type of investments that the person has made, and combined together they form their portfolio of investment. In this topic, we will be discussing just financial securities, and even in financial security, our main focus will be on stocks, because stocks are relatively risky investments compared to bonds. In bonds, you get a fixed interest payment, whereas in stocks, there is no fixed return. The stock dividend might be paid, might not be paid, and even the stock price is very volatile. So basically we are considering risk if you invest in stocks over here. So no investment should be undertaken unless the expected rate of return is high enough to compensate the investor for the perceived risk of the investment. This is a very important point, that investor will not invest unless they believe that the higher risk that they are taking, if they are taking more risk, it should be compensated by more return, or else there is no use of taking on the extra risk. For example, I'm going to open a note for this. Okay, so for example, we have two options. One is to invest in the government bond, and the other is to invest in the stock market. Now, if the government bond is giving a sure 10% return, and government bonds have the least amount of risk, because it is very unlikely that a government bond is going to default. So, over here, this rate is considered to be almost risk free, because you know that they are at least not going to default. And if it's a bond, then the interest payment will be fixed, and you will know what is the par value that you will get. Whereas if you invest the amount in the stock market, you will have to bear the risk of default as well, because a company might go into default. Similarly, the stock price might fluctuate, and even the dividend over here is not fixed. It depends upon the management. So if you are taking a higher risk, so if let's say over here also the return is 10%. Now, as an investor, one option is less riskier. Over here, you know the fixed interest payments that you will get. You know at maturity what is the par value that you will get. So, over here there is less risk and the return is 10%. Whereas over here, you do not know what will be the future stock price, and you're not sure about the dividend payments that you get. So, the risk over here is high, but over here also you are getting a 10% return. So as an investor, you would prefer this option, because for the same amount of return, the risk is less and you are risk averse. So you will prefer the option that is giving you the lower risk level. Whereas in the stock market, you will be willing to invest if, let's say, the stock market is giving you a 15% return. So if the expected return in the stock market is 15, then you will be enticed to take on the extra risk. ठीक है, अब ज़्यादा रिस्क तभी लेने के लिए तैयार होके जब आपको लगेगा कि आपको वहाँ से फ़ायदा भी ज़्यादा होगा. अगर आपको सेम फ़ायदा होगा तो आप एक्स्ट्रा रिस्क लेना ही नहीं चाहोगे. Over here, you're getting a sure 10% return with a lesser amount of risk, so you will prefer the government bond. लेकिन अगर दूसरी तरफ आपको 15% का return मिल रहा है, you will be like, okay, I'll take on the higher risk because I have a chance of getting a higher return over here. So this is basically what this sentence means, that no investment should be undertaken unless the expected rate of return is high enough to compensate the investor for the perceived risk of the investment. So this gives you a very simple rule in finance which says that the higher the risk, the higher will be the expected return. But remember, if the risk level is high, that would mean the chance of loss is also more over there. So it might be कि आपने कहीं पे इन्वेस्टमेंट किए, रिस्की इन्वेस्टमेंट किया, अगर इन्वेस्टमेंट में फ़ायदा हुआ तो आपको अच्छा खासा रिटर्न मिलेगा, लेकिन अगर इन्वेस्टमेंट में लॉस हो गया तो आपको उतना ही ज़्यादा लॉस भी वहाँ पे बेयर करना पड़ेगा. Okay, so the higher the risk, the higher will be the return. Now moving ahead, how do we calculate investment return?